I'm kind of bullish. I'm very bullish. Long-term bullish, short-term bearish, right? Because of the mining capitulation, which we did see, and I'll probably just share a chart. So I've got the hash ribbons here, which is the hash rate on the network, and they're just different moving averages, so you can see easily visually the expansion of.
Whoa, that's a huge drop. That's like what happened in the early 2019.
No, it's way worse. It's the biggest hash rate drop in the history of Bitcoin, right? This is validated as the biggest drop. This was a tiny drop.
No, I meant like the mining ribbon. I like the
wow, so
this
is like the biggest hash rate and difficulty drop in the history of Bitcoin, because 60% of the hash rate suddenly got banned, right? So but we are in recovery, and so when the hash rate drops, miners are going out of business, they're shutting down their miners, and they sell their coins to relocate or to liquidate because they're out of business. So that's what we saw here. Once it recovers, it means the rest of the mining network ain't going to sell their coins, because all the weak miners are sold and they're going to hold on. So that's what's happened now, and we're in recovery. And if you look at that, that was your bottom signature from the ribbon there, which is not too bad in terms of vertical movement and price. And this is the ribbon for the bottom of the bear market, right on there. So pretty good indicator. Yeah, so miners are in recovery. We're in a bullish phase. Typically when miners capitulate and we expand back up and recover, we've got multiple months of bullish price action, like 3 or more months. Historically speaking, anything can happen, of course, but historically speaking, we're set up to go up now. Like this movement down here is like Elon Musk flooding energy, bullshitting his way into, I don't know, his relevance for green credits, and China banning. Oh, the rumors of China banning. Actually, that started here, and then the banning of miners in China here, and then there was an onslaught of bearish FUD from members of central bank cartels and whatnot. So we saw a massive attack on Bitcoin over this last 2.5 months, and it weathered that by a halving of price, and it's obviously we can see that now it's bounced back stronger than ever. So yeah, it's a very good test for Bitcoin. I was saying here, fundamentally, it looks very strong. People were saying it would go down to 20s, but it didn't look like that. It looked very strong here. It didn't look like we'd complete this. What was forming was head and shoulders, going down to 23-ish was the expectation. But instead what happened was we started grinding down, and what was happening was traders got ridiculously bearish on the price action. So they started to sell down their positions, and so when this dump happened, it was fundamentally strong selling from real investors, long-term investors, dumping like there's no tomorrow. And obviously when they sell, someone's got to buy, and that wound up on the exchanges. So the speculative inventory on spot exchanges was at a very local high, and traders had control of those coins, and they started to sell and short the market down. But if you were to look at which it's a simple metric of how many coins in the system that you cannot buy versus how many you can. It's the ratio between the two. So the more that you can't buy, this goes up, and so you can measure it two ways.
It goes up when you can't buy them.
Yeah, like if say there's like 10 times more coins than that you can't buy versus the 10% you can buy, and then that grows to 20 to 1. Well, this ratio is the ratio.
This is rise right there.
This is the ratio is 6.5 to 1 there, right? The 6.5 to 1 and the ratio here is 3.4 to 1. And these are two different metrics. This is like what I'm using here. What you can't buy is what's in cold storage, and what you can buy is what's on the exchanges. This is what you can't buy is Rick Astley's coins, and what you can buy are the coins held by speculative investors. So this is Glassnode's liquid supply. They do forensics onto the entire blockchain and all the wallet spaces, and then they look back on. It's essentially Google surveillance on the blockchain, going, oh, you're a long-term holder, you're a speculative guy. And then they go, right, we're going to classify your coins as Rick Astley. You're not going to sell. And we're going to classify your coins as weak hands. You're speculative. You buy, you sell. And so this is the ratio between the two. And it's the qualitative view of supply shock, where this is a quantitative, which is sheer number of coins that you can see on exchanges versus not. And they both very much track price, and they've been tracking each other. So as traders have been selling down in their bearish pawn charts they were sharing once between each other, long-term investors, particularly the qualitative views of Rick Astley's, the strong hands were scooping up coins like no tomorrow, knowing that this was a dip, unaware, like traders totally unaware of it, expecting lower 20s, and eventually like the supply shock took hold, and the reality of less and less coins on the sell side of the market took hold, and this thing started pumping. And at this point here, we had a full-on squeeze. I remember that candle clearly because I'd just woken up, and this thing was shifting like, what was it, a $3,000, $4,000, $5,000 move in sheer minutes. That was the total squeeze. All of this was like buying, and then there was a final squeeze up here, and now we're up against
right. So that final squeeze, that was the July 30th, right, when we started falling from 40,000 down to 38, and then immediately reversed for about 4G, right?
Yeah, totally. Let me grab your. This is like, you can see how price and supply shock are very correlated right now in this phase of the market, because this phase of the market it's actually quite spot investor dominated. Like we're not in a phase where price is highly FOMO and it's all dictated by derivative exchanges with traders like getting high and moving price up and down. We're in a phase where the fundamental price action is dominated by the buying habits of like long-term investors putting a floor under the price. And like if you look at the level of supply shock we have, like all the coins that were dumped onto the market and held by speculative hands have been mopped up, and they've been mopped up, and we're at the same levels as we were in the $55,000 to $65,000 highs. And so if I go to this point here at the same level of supply shock and move up to here, we're in the $55,000 zone of the last visited level of supply shock. If you look at exchange supply shock, we're at all-time highs. But this number is a little bit sketchy because it involves labeling all the addresses on the exchanges, which is subject to error. And so there's a lot of weirdness right now because there's some debate as to whether some exchange transactions were internal versus external. So this is less reliable, and I haven't like posted any charts using exchanges lately because this data needs to consolidate. And I spoke to Glassnode, and they're still looking and monitoring it and figuring out what's internal and what's external. But this one is like much more reliable, and so the market needs to move upwards if it's going to find balance to historic levels of supply shock. Because we're not there yet. Like 42,000 or below is too cheap given the scarcity of coins on the market.